Well, let me first thank Paul and the organizers for giving me the chance to present this paper here. This is joint work with my colleague Patrick Bolton at Columbia, and as you can see, this is a paper on the empty creditor problem. So let me first define what we mean by the empty creditor problem. So the empty creditor is really a term that's been coined in a series of papers by Henry Hu and Bernard Black. Henry Hu now at the SEC, Bernie Black, a law professor, I think moving to Kellogg. The empty creditor problem kind of starts from the observation that when you purchase a CDS, a credit default swap, that leads to more than just transferring risk from one party to another. And in particular, what it also does, it partially or even fully separates your cash flow rights from your control rights. So think about owning a bond. You insure the bond through CDS. You hedge your cash flow exposure, but you retain important control rights such as voting rights, right? And so this, and that's what this paper is going to be about, can alter fundamentally the relationship between debtors and creditors, particularly at the time of distress, right? And so here's a quote from one of the papers that Hu and Black have written on this, where they say that, even if a creditor has zero exposure, just, hedged its exposure, not even gone short on that, then if a company is in trouble, the creditors might want to push the company into bankruptcy in order to collect on this credit insurance rather than agreeing to, say, a debt restructuring, even in cases when the debt restructuring would be the efficient outcome, right? And that's what's been called the empty creditor problem. Now, let me give you a quick example. And if you look at the back of the paper, we have a table with a number of more examples. In fact, if you go to my website and look at the newest version, we've added a lot of detail there if you're interested in more of the details of the different examples we're giving. This is I picked this one because it's the most current one that we have, YRC Trucking, a US trucking company. After a series of acquisitions in late 2009, they had trouble meeting their debt service, so they tried a debt for equity exchange. And despite substantial support from most of the creditors, there are a bunch of creditors who very fiercely opposed this debt for equity exchange, right? And at first that seemed puzzling because you could go to any bankruptcy expert and they would say, well, what they're going to get in Chapter 11 is probably much less than what they're going to get in this restructuring deal. But still they were opposing, so the feeling here is that through their CDS positions, these creditors would be profiting from bankruptcy in this case, right? And now, to tell you what happened at the end of this example here, a debt restructuring actually was successful eventually. That happened when the Teamsters Union threatened to protest outside the offices of some of the hedge funds that were supposedly holding out and had purchased the CDS protection. Now, what we want to do in this paper is give kind of a little more structure or formal analysis to this empty creditor problem. And in particular, think of it both from an ex post but also from an ex ante perspective, which I think is very important. And so the central kind of message I want to get across is that the effect of CDS here really is a shift in bargaining power from the debtor to the creditor. And that actually has some pretty positive effects because CDS in this model that I'll show you in a second will act as a commitment device for the debtor, for the borrower, to pay out cash flows, right? And that's going to generate ex ante benefits in the terms of you can get more investment going, and also it reduces the incidences where a debtor will want to default strategically on its debt. But, and that's the flip side of this, we also show that in equilibrium, the creditors do, in fact, tend to overinsure. And that's the inefficient empty creditor. And what do I mean by overinsure? I mean, they are going to purchase credit protection to a point where renegotiation with the debtor is going to break down, even in cases where it would be efficient to occur. And that's an inefficiency not just ex post, but also if you go back to time zero in the model, this is an ex ante inefficiency. And this inefficiency, let me say right now, arises even, you might think, is there a mispricing in the CDS market? What we'll show is that this arises even when the CDS market perfectly anticipates this value-destroying behavior of the creditor down the road. All right, and then at the end, I'll show you that we believe that going through both the ex ante and ex post leads to a slightly more nuanced view that you can then take on, say, the policy on policy implications or policy analysis than what existing law and economics papers say. Okay, let me skip the related literature for time's sake, and let me show you the model. So this is going to be a really simple kind of standard corporate finance model. We're going to have 3 periods, 0, 1, and 2. There's a risk-neutral firm. That firm has an investment project it can undertake. So at time 0, it can pay F, a fixed investment, and then generate cash flows from that investment for 2 periods. At each date, cash flows can take 2 values, either high or low, so C1H or C1L, with probabilities theta and 1 minus theta. And then at time 2, the time 2 cash flow can be C2H or C2L, high or low again, with probability phi, 1 minus phi. And theta and phi, we allow them to be different. They could be the same. We assume that they're independent draws. We could put some, there's a lot of stuff you could do here. That's all not really crucial to the model. Now, what we do assume is that at time 1, the firm kind of has an understanding of how profitable it's going to be. It has some sort of signal of its future profitability. So for simplicity, what we assume is it knows at time 1 the cash flow it is going to generate at time 2. What that means is when you service your debt at time 1, you're going to be trading off, thinking about how valuable is it for me to keep this firm alive and make the debt payment, or should I maybe not make the debt payment? And we also assume that at time 1, you can, if you want to, liquidate the project. You get L in liquidation. We are assuming L is smaller than the low time 2 cash flow. That means liquidation is inefficient in this model because you get at least C2L by through continuation. And so that captures costs of either an outright liquidation, think of a Chapter 7 cash auction, and that could have some sort of fire sale component, or think of costs of a reorganization, Chapter 11. So that's what we're trying to capture here. Just to make the model simple, I'm going to normalize 2 parameters. I'm just going to set L, this liquidation value, to 0, and also I'm going to set the low time 1 cash flow to 0. That's just going to make the expressions we're going to have a little simpler. You could make both of these positive and wouldn't change the model. All right. So the firm has this investment project. How is it going to finance it? Well, we assume that the firm is going to use debt, right? And it's going to go to a single risk-neutral creditor. And we have an extension in the paper that looks at multiple creditors where you get some more effects going. But for the sake of this talk, most of the effects we already get with a single creditor. So the firm goes to a single creditor and raises money via a debt contract. And the crucial friction in this paper is that the firm faces a limited commitment problem, as in the papers of, say, Hart and Moore, or also Patrick's earlier work with David Sharfstein. In essence, what that means is at time 0, when you write the debt contract, you can't contract on the realizations of the time 1 or the time 2 cash flow, right? And so what does the debt contract look like here? Well, it's going to specify a contractual payment. Think of it as a face value, R. That's going to be due at time 1. There's going to be no payment due at time 2. That's kind of a standard thing in these models. With limited commitment, you can never force any payout at time 2. So debt will come due at time 1 in this model. Now, if the firm repays the face value R, then it can continue and collect the time 2 cash flow. If it doesn't, then the creditor has the right to take over and liquidate the firm, push it into Chapter 7 or Chapter 11. But the firm at that moment can come back to the creditor and make a renegotiation offer. How does that work? Well, the firm can make the time 2 cash flow, which it knows at time 1, can make it verifiable by paying some sort of auditing cost, like a proportional verification cost. And so if the cash flow at time 2 is going to be C2, there's going to be a renegotiation surplus of lambda times C2, where lambda is smaller than 1. Right? So if the firm either cannot repay or doesn't want to repay its debt, they can offer up to an amount of lambda C2 to the creditor in order to renegotiate. OK, in the end, we want to talk about CDS markets. So let me tell you about what they look like in this model. We're modeling CDS markets here kind of as standard competitive insurance markets. So the creditor can go to a protection seller, say some sort of insurance company. And this insurance company is also risk neutral. And the creditor can purchase CDS protection that is defined kind of by 2 values here. So you can purchase an amount pi of CDS protection. That's the notional. So if a credit event occurs at time 1, and I'll be specific about what the credit event is, then the CDS contract pays you pi, right? So that's what you receive in the case of a credit event. When you enter the CDS contract, on the other hand, at time 0, you pay a fair premium, right? And that fair premium, of course, is going to, it's a risk-neutral market, is going to be an expectation, the payout that the insurance company will have to make in the future, right? So phi is the insurance premium, pi is the CDS payout, conditional on the credit event occurring. Now, what's the credit event? For the credit event, 2 conditions in our benchmark model have to be met. And here we're trying to kind of mirror what the standard North American CDS contract does, as defined by ISDA. The first is that the company doesn't repay or doesn't make its contractual payment R, right? So kind of failure to repay R. But then on top of that, in order for the CDS to pay out, there has to be no mutually acceptable renegotiation, or you could think of it as kind of out-of-court restructuring or debt restructuring between the creditor and the debtor. Now, what this means is that, you know, if you know about or have worked with CDS markets, this is a contract that would be called a CDS contract that doesn't have a so-called restructuring clause, right? And there are other CDS contracts that that trade that do have restructuring clauses, but this at present is the standard contract that that ISDA issues, and that's for a number of reasons. The restructuring clauses have always been kind of messy to enforce, and so on. Okay, now finally, before we solve the model, how does out-of-court restructuring work? Well, we're just modeling it as a simple bargaining game. So recall, if the firm doesn't repay its debt, it can make the time 2 cash flow verifiable, and it has a renegotiation surplus then of lambda times C2. And then this renegotiation surplus is split between the firm and its creditor according to kind of bargaining power weights, Q and 1 minus Q. And that's the case absent CDS. So absent CDS, the firm has some bargaining power, the creditors, and the renegotiation surplus is split, and the lender, the creditor, receives a fraction Q of the renegotiation surplus. Now, this is where CDS come in this renegotiation in our paper, because, you know, it's a risk-neutral model. There's no real insurance benefit here of CDS. The value of CDS for the creditor in this model is that it gives the creditor an outside option when it renegotiates with the firm. So once you have CDS and the firm doesn't make the contractual payment, then the lender suddenly has an outside option. It can say, no, I'm not going to renegotiate. I'm going to collect pi from the insurance company, right? And so what that means is now in renegotiation, the firm is going to receive the maximum of what it would receive absent CDS, Q lambda times C2, or its CDS contract, right? So by purchasing CDS of an amount pi or increasing this level of CDS pi, you can squeeze out more when you renegotiate with a firm. Now, one other important effect is if pi exceeds what's on the table to be renegotiated for, right, then you can't renegotiate anymore, because then it's always better for the creditor to collect pi than to say yes to renegotiation, because lambda times C2 is the maximum the creditor can get in renegotiation. Okay, now I want to show you kind of run through the model quickly 3 times. The first example I'll show you is what happens in this world without CDS. Then I'll show you what level of CDS would a social planner choose, or what is the efficient amount of CDS we would like to see purchased in this model. And then finally, I'll show you what the creditor actually does, and that differs from the efficient solution. All right, so if you've worked with these models, a standard result is a default can occur for 2 reasons here. One we call a liquidity default. You just don't have any cash at time 1. The low cash flow realizes you can't pay. Or the high cash flow realizes at time 1, but you don't have an incentive to repay. You want to run away with the time 1 cash flow and just leave the firm to the creditor. Or actually what you will do is you will run away with the time 1 cash flow and then renegotiate. And this strategic default occurs as an incentive constraint, right? On the left-hand side, you pay back R, and then you get the entire time to cash flow. If that's less than running away with C1H and taking your fraction of the renegotiation pie, then you're going to default strategically. Now, when you work through this model, what you find is that, and I'll show that in a picture, there are essentially two outcomes. The first, you can see on the top, you can see here the setup cost F. On the top, there's going to be some cutoff F hat. Below F hat, if the project costs less than F hat, you can finance the project, and strategic default will not occur in equilibrium. Beyond F hat, you cannot finance. Or another case that can occur depending on parameter values, in particular, this case occurs when strategic default is not very likely. You can finance it up to F hat without strategic default, and then there's going to be a region where you can still finance the project, but only with having the creditor defaulting strategically sometimes, which is costly because then they pay this auditing cost, which, strictly speaking, you don't have to pay. Now, two inefficiencies I want to highlight because I'll show you how CDS will alleviate them. The first is underinvestment. So some of the projects to the right of where the respective cutoffs are going to be positive NPV projects that don't get financed here. That, of course, is not surprising in a limited commitment model, right? And the second is that sometimes you do get financing, but it's inefficient, and that's this region here where in order to get the project going, you have to live with the fact that sometimes you see costly strategic default. All right, so now let's introduce CDS and see what happens, right? So recall now the lender will get more in renegotiation. He'll get the maximum of what he would get absent CDS and his CDS protection. So what this means is that in any situation where renegotiation occurs, be it because of a strategic default or a liquidity default, the creditor now knows he can extract more. And of course, seen from time zero, that means he's going to be willing to extend more financing. The second effect is if you rewrite this incentive constraint I just showed you, clearly now, when you think about should I pay or should I not pay, you are going to be anticipating as a firm that your creditor is going to be tougher in renegotiation. That reduces your incentive to default strategically and reduces the incidence of strategic default, which, as I said, is costly here. So those are the two kind of positive effects of CDS. But renegotiation, as we said, in some cases now, if pi exceeds what's available to renegotiate for, then renegotiation will become impossible and break down, and then the firm will go into Chapter 11, which is costly. So that's kind of the downside of CDS here. And so now we can ask ourselves, well, if we think about kind of an efficient outcome in this market as a benchmark case, what level of CDS should the creditor choose? And the first kind of very simple observation is that, well, the creditor should at least choose a CDS notional equal to the low realization of the renegotiation surplus. Why? Well, because he strengthens his bargaining position in renegotiation, decreasing strategic default and increasing what he can extract in renegotiation, so increasing investment ex ante. But he will never cause a breakdown in renegotiation, right? Because the renegotiation surplus is always equal or larger than the CDS amount. And so these are the two pictures I just showed you. What happens now is that, for example, in the first case, rather than being able to finance up to F hat, you can now finance up to F tilde. So we've increased investment through the CDS position. Or in the lower case, here we eliminate the interval where there was strategic default, and we can finance now after introducing CDS and taking a CDS position of lambda C2L, we can finance up to F tilde without strategic default. So you can see the two benefits here, right? The increase in investment and the elimination of strategic default. All right. Now, could it ever be optimal to raise CDS protection beyond the low level of the renegotiation surplus? And this point is going to be crucial when we think about what the creditor actually does. Well, what does it mean when you raise CDS protection to the high level of the renegotiation surplus, lambda C2H? It means that sometimes you cannot renegotiate. If you choose that level of credit protection and the low renegotiation surplus realizes, there's no way to renegotiate. But the creditor now, if he chooses the higher level of CDS protection, can extract a lot when the renegotiation surplus turns out to be high. Now what this means is that if you can finance, so F tilde, remember, is the cutoff up to which you can finance by choosing pi equal to the low level of the renegotiation surplus. Now to the left of F tilde, there's no reason to sacrifice successful renegotiation by increasing the amount of credit protection. So what a planner would do, or what the efficient solution would imply, is that only if setting the level of credit protection to the high level of the renegotiation surplus allows financing somewhere to the right of F tilde, you want to do it. But only in that case. So only if it allows you to finance a completely new project, you would want to sacrifice renegotiation surplus here. Now, finally, then this is kind of the third incarnation of the model. Let's think about what the lender would actually do. Now, the lender, think of it this way. The lender takes the bond, or the bond gets issued to the lender. Now the lender turns around, and he doesn't think about, does the CDS position allow this project to be financed or not? What he thinks about is which CDS protection, lambda C2L or lambda C2H, is going to maximize the payoff that he gets from owning the bond, right? So he will ask himself, well, if I set the low level of, or purchase the low level of credit protection, I can always renegotiate, but I can usually extract less in renegotiation, particularly if the renegotiation surplus turns out to be high. Had I chosen a higher level, I could have extracted more, but I didn't. Right? Or he can say, well, I'm going to actually purchase a high level of credit protection. Sometimes now I can't renegotiate, but if there is a lot of renegotiation surplus now, I can really squeeze out a lot. What this implies, if you can compare these two values, and what you find is that if C2H is sufficiently high, so if there is a chance that there's going to be a lot to extract after a liquidity default, then the creditor will choose the high level of credit protection and sacrifice renegotiation surplus, even though this might be a project that lies somewhere here that we could have financed anyway. Right? So that shows that even when the CDS perfectly predicts the value-destroying behavior by the creditor ex post and perfectly prices that, still there will be an incentive for some projects in equilibrium for the creditor to overinsure and cause an inefficiency here. And that's the sense in which we do get in equilibrium this inefficient empty creditor that I talked about at the beginning of the talk. Okay, let me conclude by spending 1 or 2 minutes on what we think this model implies for policy. Now, the first observation is that, and that's just a very general statement, of course, is that we would argue that any policy relating to the empty creditor problem should be should look at both the ex ante and the ex post effects and take into account the two effects that this model highlights. There's this positive commitment role, but at the same time, there is the socially, say, inefficient rent extraction role of CDS. And any policy you want to design should be mindful of both of these two effects. Now, the existing law and economic literature focuses almost exclusively on the socially inefficient kind of rent extraction view of CDS in renegotiation. And so what we would argue is that a lot of the proposals we've seen might actually be over-inclusive, at least if you look at them in terms of our analysis here. So let me give you a couple of examples. One thing that's argued a lot is, well, one way to get out of the empty creditor problem is just make voting rights proportional to your economic exposure. So if you hedge some of your cash flows, then your voting rights shrink in proportion. Now this, as a categorical rule, this would not be optimal in our framework, right? Because sometimes you actually want the shift in bargaining power, because the CDS, particularly as long as the CDS only affects the terms of a restructuring deal but does not lead to a breakdown in restructuring, it's actually a positive effect to see this shift in bargaining power to the creditor. The second thing we can, that's been argued a lot as well, just make restructuring a credit event for all CDS. Now, there are other problems with that, which I don't really have time to go into, but historically, ISDA has struggled with these restructuring clauses. But what our model would say on top of that is, well, you do get rid of the empty creditor problem, the exposed inefficiency, but by doing this, you also eliminate all the commitment benefits. Essentially, it takes away this outside option from the creditor. Now, finally, disclosure. I think this model highlights another potentially positive effect of position disclosure. In this model, if the lender has to, or if the creditor has to disclose what he purchases as CDS, this might make the CDS position contractable, and then the firm and the creditor might be able to both agree or make the CDS position and the bond position conditional on both the borrower and the lender agreeing to this position. That might be one way around the overinsurance. So to wrap up, this is a model of the empty creditor problem that I think is the first to highlight both kind of the ex-ante and the exposed effects. In particular, highlight this commitment effect that comes through the shift in bargaining power when creditors purchase CDS. In terms of policy, we would argue you should be mindful of both these benefits, and thus of the benefits and the costs, and thus you should not be over-inclusive in what you do. And I close here. Thank you very much.